Hi, good morning, everyone. So it's 11:15. We have quite a few. Thanks for joining us for our morning call. We have quite a few counter updates, so we'll just start. Terence.
Yep, thanks, Glenn, and good morning, everyone. SPH and Cuscaden Peak have entered into an implementation agreement in our next slide. Yep, so like we mentioned, SPH and Cuscaden Peak have entered into an implementation agreement to privatize SPH via a scheme of arrangement after Cuscaden raised its recent offer to $2.36 or $2.40 per share. So Cuscaden's revised offer comes with the optionality of a higher total value of the cash and SPH REIT consideration while continuing to participate in the potential future growth of SPH REIT and receive its distributions or value certainty associated with an all-cash consideration. In a table here on the right-hand side, we compared the two offers between the Keppel scheme and the Cuscaden scheme. So if you look under the Keppel scheme, there's only one option, which is a total consideration of $2.35 one per share. This $2.35 one per share consists of 86 cents 8 in cash and 0.782 SPH REIT and 0.596 Keppel REIT units per share. Noteworthy is the material adverse effects clause has been waived under the Keppel scheme. This means that they cannot walk away from the deal if SPH financials are adversely affected by some one-off events. The Keppel has guided for their estimated time for payout to be mid-Jan 2022, and the approvals required has been obtained. Under the Cuscaden scheme, you'll notice two options, option 1 and option 2. So under option 1, they offer shareholders a higher cash consideration of $2.36 per share for under option 1. Under option 2, there is a illustrative price of $2.40 per share. So this $2.40 per share is made up of $1.60 2 in cash or plus 0.782 SPH REIT units. So it's similar. In terms of the SPH REIT payout, is similar to Keppel's. The material adverse effects clause is in place for now. The waiver will only take effect from the date of the dispatch of the Cuscaden scheme document and also subject to other conditions as well. Cuscaden expects the time for them to pay out to be slightly later in February 2022. The regulatory approval applications have been submitted and no approval is required for offeror shareholders. In our next slide, we consider the merits of both offers. For Keppel's offer provides the shortest time to pay out. So when we compare both, Keppel's offer is faster. If approved at the Keppel scheme meeting on the 8th of December, the payout is to be expected sometime in mid-Jan 2022. Even though Cuscaden say their offer, they expect to conclude in February, we note that for Keppel, they took about 3 months to get all the necessary approval. So we think that there could be some slight delay in Cuscaden's offer. So that slight delay adds a little bit of uncertainty because of some of the measures we elaborate shortly. But when we another thing when we compare the two offers is Cuscaden's offer provides shareholders with more choice. The revised Cuscaden offer gives shareholders a choice between value certainty with an all-cash offer or the opportunity to participate in the potential future growth of SPH REIT with a part share, part cash offer. Another difference is that Cuscaden's offer is also higher in value and value certainty. The revised Cuscaden offer is higher than the implied value of the Keppel scheme consideration of $2.35 one per SPH share. So our view is, despite offering more certainty of due completion, and the time to pay under Keppel's offer. The reason why we say it offers more certainty of due completion is because SPH has already lifted the Newspaper and Printing Act. So some background of the Newspaper and Printing Act. Under the Act previously, when it was in place, shareholders cannot accumulate more than 5% of SPH because it's considered a national asset. But with this now lifted, then it means that there's no restriction on who can be a shareholder. This means that there's a potential, not saying that it will happen, but there's a potential that there could be some other competing offers which could complicate the whole entire completion process. So the Keppel deal with the shortest time to pay out, that offers more certainty of deal completion. So even though the Keppel deal offers more certainty, but we believe SPH shareholders will likely go for Cascaden's offer, since this provides a higher total consideration value and value certainty. So the catalyst in our next slide, the catalyst to look out for Keppel then is the announcement of the potential combination of Keppel O&M and Sembcorp Marine. The potential combination is expected in the first quarter of 2022. And both Keppel and Sembcorp Marine have previously announced that the talks have been are going well, and they expect them to just tie up some of the loose ends. So completion timelines still expected for first quarter 2022. In terms of our recommendation, we maintain our buy call is unchanged, and our sum of the parts target price of $7.07 is also unchanged from previously. We reflect this new target price is reflected based on its 4 new segments that we changed recently to better reflect the group's reporting segments going forward. So that's all from us for Keppel. I'll now hand over the time to Vivian.
Thanks, Terence. This is Phillip on the ground for UMS's 3Q21 results, and we do not have coverage on UMS. So in the next slide, very quickly, if you look at the table on your left, you can see that the 3Q21 results continue to be very strong. Revenue is up about 50%, and this is due to the higher revenue from all the segments, mainly from the semicon segment, which is up 41%. And also the consolidation of the JEP business. So that includes the aerospace segment and also the semiconductor components business. Referring to the key highlights on the right, you can see that UMS saw record revenue and profit levels on a 9-month basis. For first 9 months of 2021, both revenue and profit surpassed the FY20 levels. So due to the same reasons mentioned previously, and also of course the sustained growth of the semiconductor industry. Some quick updates on the operation side. For the Penang facilities, they have resumed full production headcount since October from a 60% workforce capacity constraint in August and September, which partly impacted their operations. Next point, for the key customer, UMS's key customer, there has been a positive guidance. So the key customer, which we think that they produce applied Endura machines for, announced in their 4th quarter of FY21 results that they are expecting net sales for first quarter of FY22 to be $6.16 billion. This is up 19% year on year. And on a quarter-on-quarter basis, it's slightly higher than the $6.12 billion net sales achieved for 4Q21, and this could be attributed to the tight components shortage situation. So lastly, on the market outlook, to tackle the supply chain challenges for the semiconductor segment, UMS has increased orders to have a larger buffer stock for integrated systems. And for the component segment, their subsidiary, Stark, is able to help in ensuring the availability of the key raw material, which is aluminium for them. So it will also be good to know that for UMS, with Stark, which is their subsidiary to help them source for components and parts, the labor issue is actually more of a concern for them, including the shortage of the foreign workers in Malaysia, but there are plans to gradually reduce this effect. So that's all for UMS. I'll now be passing on the time to Timothy for Willas-Array.
Thanks, Vivian. Just another Phillip on the ground for Willas-Array Electronics. They are an electronic component distributor in selling to China, Hong Kong, and Taiwan, listed in Singapore. So they're quite a small player, market cap only 61 million. But they're able to give us some color on the supply chain shortages, component shortages that's happening now. So they mainly sell to industrial, home appliance, and automotive customers based in China. So they have 20 reputable suppliers, including Sony, Toshiba, and Microchip Tech, all these large suppliers. And they purchase 49% from the top 1 supplier, and 84% of the purchases they make are from the top 5 suppliers. So with regards to their results, they did well. So revenue was up 6% year on year, with the automotive segment showing the largest growth of 19%. And the gross profit was up 25%, mainly because of margin improvement from up from 8% to 10%. So the better results mainly came from higher demand. So there's high demand mainly due to the management stated that it was mainly from China environment targets. So in China, the electric vehicles, clean energy production sectors, and the sales of power saving appliances like washing machines and fridges, air conditioners. Because of the Chinese government's push to meet environmental targets, all these demand from all these sectors are growing very, very strongly. So Willas, their inventories levels are at historical lows, very low at the moment. As stated by them, it's uncomfortably low. So if you look at the chart at the right-hand side, the top one, the inventory levels are around 200 million Hong Kong dollars at the moment, whereas in the past it was near 300 million. And if you look at the inventory turnover ratio, which is the days, the number of days it takes Willas to sell off the inventory, is also at historical lows of very low levels of 23 days only. It used to be around more than 30 days last time. So the supply, they stated that the supply issue is there's still not enough supply, and it's still quite bad according to their view. With regards to the semiconductor shortage, they give us some color on what was the components that was in shortage, which is basically the basic active semiconductor components such as dowels and power-related semiconductors. Whereas for the passive components like capacities, the supply is still okay. So this is just a bit of color. The lead time can be up to a year now. So previously it was 2 to 3 months, and there's a few alternatives for people to buy from. So it's a broad-based kind of impact, and smaller players are more affected than the larger players. But Willas was able to do relatively better because they had good relationships with these large reputable suppliers like Sony and Toshiba. So the buyers, the customers of Willas are actually absorbing the higher prices. They're actually willing to pay more to get the components now, just to get the components now, because the shortage is just so low. It's just so bad. So Willas did well because they got good allocation from their suppliers. So they were actually able to meet the demand, the production demand for their automotive customers, and that's why they actually saw a very large growth from the automotive segment. So with regards to the outlook, first of all, the automotive segment is still very strong. This is mainly because electric vehicles have about 5 to 7 times more electronic components than a traditional car. And the penetration in China is only about 5% of sales is electric vehicles. So the growth is still expected to be very strong for automotive. But with regards to consumer, they say it's a bit softer due to the softer China economy. With regards to COVID lockdowns, there's a little bit of impact due to the shift work that they had to implement due to lockdowns. But the electricity curbs, they stated that there's little impact, mainly because of the supply shortages. So the suppliers' factories are actually being utilized at lower levels just because they don't have enough components to work on. They can't get enough components. So the electricity shortages are not really impacting them that much. Moving forward, revenue is expected to be kept mainly because of the supply, the component shortages. But the higher margins are expected to sustain because customers are still willing to pay higher prices. And because of the better results, they expect a higher dividend payout this financial year as well. So that's all for Willas-Array. I'll pass on my time on to Paul.
Yeah, thanks, Timothy. Move on to UG's Healthcare. So basically, the title is that there was a production disruption in the quarter, but it's now trading below book. Next slide. So in terms of the results, you can see from the PATMI, it's not highlighted in the box, but the earnings was down 50%, but it was actually within our forecast. I think we expected FY22 to be weak. The positives is that in July, the factory was actually shut for almost 3 weeks. And right now, because in Malaysia, how it works is that if your vaccination rate of the workforce is above 80%, then you cannot resume back to normal, which they have done. So what happened in the quarter was that when the factory was shut, they were not able, they were a bit more hesitant to clear whatever inventory they had. And do note that because UG is not just pure manufacturer, they also are distributor, especially in the Europe. So their European distribution arm was just less willing to flush out most of the stocks because they were not clear when could they get supply, especially these days where shipments can take almost one month or more. In terms of the negatives, as per the negative the last few quarters, it's just the nitrile prices continue to be weak. They dropped about, let's say 70, 80 in the June quarter to 55, 60. It's trending now to around the 30. So another big quarter for December. The only positive is that the latex glove prices have been a bit more sustainable. The drop has been maybe 10+% to 20%, and it's holding better than nitrile. In terms of the outlook, as expected, I think we still think nitrile glove prices will slide in the second quarter's results. But we think there are other drivers to margins for the company. Firstly, latex glove, which is about maybe 40-50% of the sales, is holding better because the competition from glove in China is mainly concentrated on nitrile. So just as a refresh, nitrile means synthetic rubber. Latex is actually natural rubber. Yeah. Sorry, should I clarify that earlier? But the secondly, nitrile, the raw materials, which ironically is also beginning to slide. So they're getting more quotes from Chinese raw materials suppliers. So the Chinese were not just increasing their glove, but they also increased their raw material production. So they're beginning to get some quotes from Chinese, aggressive quotes for raw materials from out of China. The third thing is that glove demand is starting to improve because of rising COVID cases, especially in the developed countries, and also they are beginning to restock up because winter season typically may see a spike in COVID cases. Fourthly, because UG is not just a producer, they're also a distributor. So the excess production that you see from other manufacturers actually can benefit a distributor because the bargaining power actually can strengthen, and actually distributor margins now actually has climbed back up to around maybe 20+%, because right now they can source better, and sometimes UG may not actually manufacture. They actually outsource some of the demand that they get from customers. So maybe right now they can actually outsource more. We maintain a clear, but we actually cut our target price mainly in line with the whole market because because of the drop in Malaysian glove manufacturer price. So we also had to cut our target prices. Okay, next slide. For Hyphens speed bar in Vietnam, because I'll explain later. Next slide. So the results was modestly above expectations. There's very little, because this is an update, so you can see from the table, they just gave a few bullet points on the some snapshot of the financials. So on the positives was that the proprietary did well. You can, they don't really break it down, but they just mentioned that because Vietnam was weak, so their consumer proprietary brands, which is namely Ceradan and TDF, performed better. Ocean Health, which I guess we all know, the supplements, that one is a bit more stable. The growth isn't as high because of the competition, but they're performing better in corporate sales and exports. So you can see from the results, sorry, just to refresh, the results on the right, the profit was up 30% year-on-year, but it's a bit illusionary because the prior year, the third quarter of last year, there was a big write-off of inventory. The negative is that they've been hurt by a severe lockdown in Vietnam. You know, in Vietnam, the lockdown is different. But you're almost like in jail, their version of lockdown, because you only can go out to shop for essentials once you're given a coupon. So their lockdowns in Vietnam is much tighter than what we, I guess, see here. So that's why, as a result, there was a lot of, in Vietnam, they do a lot of specialty pharma, which is basically, for instance, one of the main ones is when a patient performs X-ray scan, you insert a certain type of dye. So there's less essential medical procedures because of the lockdown. So as a result, they got hit because there's less procedures, less tests. So people go to the hospital less, or maybe can't even go unless it's emergencies, I presume. So that kind of hurts the business in Vietnam. Right now, it's modest. It's starting to improve as the lockdown schemes. In terms of outlook, they got two parts of the business, which is specialty. Specialty is basically like a fancy name for just that. These are products sold to doctors, which in turn dispense to patients like us, I guess. That is a stable cash flow generator, but the lockdown in Vietnam will probably stifle the earnings in fourth quarter. And we still maintain accumulate. We raise our forecast a little bit. FY22 is unchanged. Basically, this is a long-term growth because this company is basically taking this investment and journey into just building up their three core brands, which is Ceradan, TDF, and Ocean Health. There was another positive for them was they made an acquisition. 16 million is small because it's a small company, but I guess the key thing is that this acquisition can lift their earnings per share by almost 25-30%. Yeah. Next slide. Next slide. Yeah. Oh, okay. Anyway, for Q&M, the results was better than was modestly better. Mainly the positive was because of the test business. So if you look at the table on the left, the test business, you can measure it using the minority interest because they have owned 51% of the test. So you can see that the test PATMI was 4.4 million, whereas the core dental business is 5. So you can see that the test is almost as big as suddenly grown so huge that it's almost half as large as the dental business. So that did well because we had such a huge surge in cases in the September quarter in Singapore. The most important for us is the clinic. So they continue to expand. So they expanded 3 clinics in the September quarter. They plan to ramp it up by 9 to 10 in the fourth quarter. And so this year, they would have 17 new clinics. So this is huge for them. I think the previous time they had such a huge increase was, I think 9 was the largest in 2019. So this will add almost 10% to growth by these new clinics. The other positive was the quarterly dividends. So dividends, well, they pay another 1 cent. There's no fixed dividend policy, but our forecast is they're paying probably around a 6% yield right now. The negatives is that the dental earnings decline. I mean, we were surprised. You can see from the table on the left again, dental was down 18%. This is our estimate. They don't really break it down. We believe the lockdown in Malaysia and also the surge in pandemic cases was the one that caused earnings to decline. In terms of outlook, the record number of clinics will be the main driver for FY22. And what has happened is that they actually added more resources. Used to be only 1 person does recruitment. I think now they boosted the team to almost 9 to 10 people. So that will help in terms of like rolling out more aggressively new clinics. So they target at least 20 new clinics per year. So we kept our FY22 earnings unchanged. What they said is that of course authorities are transitioning more to ART tests, so that will hurt the PCR test because PCR test probably more for international travel and for cases where you need to confirm whether a patient really has the PCR before they enter hospital. But of course, they mentioned that they're unclear if they are pursuing, but they found that this is obviously an interesting area in terms of doing the ART test. So we maintain a buy. We lifted our earnings a little bit. We evaluate as like a sum of parts. So the core dental is 25 times. The PCR test, we just kept it at 60 million, although on the PE is very high, but because of the uncertainty, and this is the value which the associate Ausin, the listed associate Ausin purchased the PCR business. So we just leave it at that price. And then we just mark to market the Ausin dental business at a 20% discount. Next slide. So last one for me for results is Singtel. So for Singtel, results was more or less within our expectations. So what did well for them was the Australian mobile. You can see the box on the left. Australia earnings jumped 11%. So what has happened is that their mobile service revenue actually grew, and their ARPU actually jumped up, which is quite a rare feat because it's very hard for, it's always been a tough for mobile operators to raise prices. But I think what's happening, not only just them, but across the board, is the 5G. So as they transition customers to 5G and higher data plans, you're beginning to see this uplift in pricing. And it's almost close to pre-pandemic levels. The other positive, I guess the even major one was in the India again. So you can see the Bharti, the India associate, you can see the contribution was minus 89, but then this quarter it was plus 40. So you can see there's 130 million turnaround in profit. So you can see the PATMI jump from 837 for Singtel to 9. You can see they say that almost all of it came from there, I guess, in a way. So that is doing well because of the growth in not just subscribers, as more take up 4G, I presume, and also the ARPU, because competition has kind of abated after the very aggressive the last couple of years. So they managed to grow the ARPU, more importantly, by 7%. The negative was, we're not sure why, but actually they cut the interim dividends for the second time in the year, considering that the cash flow was more or less stable. But I think we think that maybe they're preparing for the 5G capex, which need to increase by another additional 200 million. So maybe that's the reason why they kind of kept their dividend. They even lowered the dividends. So, excuse me, sorry. Operationally, we think second half will be even stronger. So the reason why we say that is that associates will do even better. So the associates, like for instance, you can see on the table Telkomsel in Indonesia, AIS in India. So this will do well because in emerging markets, telco is a bit more discretionary spend. So it's not like here in Singapore, it's essential. We probably may not pay attention to how much you spend on mobile, but over there, there is a bit more income related because it's prepaid. So the higher the income, they can top up their prepaid and then they can spend more. So they're a bit more economically sensitive spending for telco. So that will benefit as lockdowns ease in these countries. For Australia, Singapore will be better because the borders will reopen. We raised our target price. Mainly, our forecast is unchanged, but we raised it because for Singtel, we do some apart. So we do EV EBITDA for Singapore and Australia, which is only 80 cents of the 286. The rest of it comes from the associates, which is mark to market. So a big influence comes from India. And then we just tag at 20%. So the India share price has jumped up quite significantly. So as a result, we actually raised our target price. Next slide. Next slide. So for Singapore, just a couple of snapshots of the macro data. Exports continue to do well, so like 18%. But we also see very strong exports out of Taiwan and Korea, which is a huge 24% jump. So Asian exports are very robust. RMC demand, so this is ready-mix concrete. This is mainly a pan-United data point, but we can see that the demand is strong, is up almost 36% year on year. So there is a strong recovery for ready-mix concrete. And it's only just 8% below pandemic levels, which is considered quite good, especially when we all know there's so much delays due to lack of construction workers. There was some new home sales data. It rebounded strongly in October, but when you compare September, October, it's still down about 15%. In the US, there was a big number, which is the retail sales, and excluding motor vehicles, we excluded because motor vehicles is very volatile. So to get a better trend, we use retail X motor vehicles. So you can see that in October, retail sales in US is very strong, almost 17%. It even accelerated from September. And do note that with pre-pandemic, US retail sales was probably trending 3, at best was 5%. So 17% is, 5 times faster than the pre-pandemic levels. And these are all records, retail sales in the US. The other thing to note in the US is that recently there were some comments. That there are always a lot of comments. Almost every day you hear some Fed official comment, but the more important ones are those in the FOMC members, which is, I think 12 of them or maybe 11 now. So 2 members mentioned that one said that they maybe favor faster tapering, and another said that maybe we should have a discussion of faster tapering. I mean, these are quotes. Don't ask me how everyone picked this up, but so these are important. It might show that the Fed might be inclined to taper even faster. So as you know, by the Fed will be tapering. That means they will purchase less treasury bonds and also mortgage-backed securities. So maybe they want to reduce less. That means they would purchase even less, which is and the other thing we'll be discussing fear on the ground. So anyway, technically, the reason why I just jumped to here is that, so technically, global growth is still healthy. I mean, if you look at US numbers, but I think the renewed lockdown is probably going to dampen sentiment a little bit in Europe. But we think there's still going to be upward pressure on interest rates because, strangely, that I guess it's very hard to argue why the central banks, like Fed, is still adding liquidity into the US economy when inflation is already 30-year high. So probably there's grounds for them to taper even faster because your inflation rate is so high, but you still want to add even more liquidity into the system. So it doesn't, probably not logical, I guess, in that sense. So for the events this year, I think you can see on Friday, there will be Thai beverage results. I think the rest is for your info. We have a webinar tomorrow. So those who are interested, now do sign up for AEM. And then next week, we have a Marathon Digital, which is Bitcoin mining. So if you're interested to understand more, can do register. These are all the webinars left for the rest of the year. Next slide. Nothing much, just to show you the cases, but I guess the one to watch is the one on the right, which is Germany. Maybe a bit harder to see because it's orange in color, but anyway, you can see, sorry, it's a bit hard to see, but the orange line, maybe I should change it to green, but the orange line, you can see that the German cases is now hitting 35,000. It's the previous high was in December, which was almost 25,000. So you can see that's why there's lockdowns coming back into Europe. You can see from the German numbers, it's like a scary spike in Germany again. Next slide. I think we all know the cases in Singapore. It's decelerating even sharper because the recent one's 1,000. I think the only point to note, I guess, in the ministry meeting was that I think the next move would be probably only end December, because if festive period, typically you might know there's more social activity, social gathering. So I think they're a bit worried that there could be a spike. So only they want to monitor that after this relaxation, and the only time is probably, I mean, nobody knows, but I guess they just mentioned that probably end December is more likely that they will ease restrictions because they want to monitor how the festive season progresses. Yeah. Next slide. And I think there's an illustration of the bounce in RMC demand. On the right is just the illustration of the residential sales. Next slide. Okay, this one just to show you the export. So the growth of exports in Singapore is still very strong. It's still at year highs, and you can see in Korea is also very strong. Although you can see the chart drop, but that's mainly because of the 3-year moving average. But if it spikes back up to 24%, the most recent data point. Next slide. Nothing much, just a US chart. You can see that the US retail sales is still hovering. If you look at the 2016, 2018, you can see the US retail sales normally 3 to 5. Now it's up to 17. So you can't really say it's the base effect anymore. It seems to be the trend line growth now. And the beige color, just to show you the amount of record spending is over 12 months. So this is not just because of a bounce from the COVID weakness. This is really like all-time highs when you look at the beige bar. Maybe it's a bit hard to see. Next slide. Okay, this is my last slide just to round it off. So we had a briefing. There was an analyst briefing on Valuetronics. This was done the prior week. So because last week there were too many results, but just to give you some information of what they mentioned. So this is a contract manufacturer with factory in China and Vietnam. Some of the products you can see on the right-hand side. So the profit was down 40%, but do know that this company has a huge net cash. So the market cap is 244, the net cash is 164. So why the weak results? There were a couple of reasons. Firstly, because of the component shortage, they just couldn't fill some orders, and some customers even canceled. The second reason is that they are facing additional labor cost issue in China. Of course, China always has labor cost issue, but this time around, what has happened is because of the pandemic, there's always intermittent shutdown because of pandemic. So whenever there's a regional shutdown, lockdown, it means this kind of discourage the workers that they get from the north to come to the south or Guangdong province to work, because many are feared get stuck and cannot get back home, especially with New Year and so forth. So as a result, there are fewer workers in the south of China, and then they have to beat up, because there's fewer, so they have to beat up, pay more for workers, and then the labor costs will rise. The second thing is the RMB, because now all their customers, they bill customers in US dollar, but the cost is RMB, and then recently the RMB strengthened by almost 8%. So again, that kind of hurts the cost again. Then of course they also lost an auto customer, but sometimes this is not their fault, mainly because of the trade war. So the customers still with them, but only use them for non-US orders. So for them right now, the key thing is now is the Vietnam plant. They have a new Vietnam plant, an even larger Vietnam plant, which will mass produce in fourth quarter, their financial year, fourth quarter, and which is probably middle of next year. And that is, they have like 2 new customers that they can load the factory in. The other data point, just to remind everyone, that they used to do a lot of GIT, where if they have to ship an order on Friday, they normally collect the components on Monday, bill on Wednesday, then ship on Friday. But right now they can't do that because everything is disrupted. So I guess that's why everyone's warehouse will be very filled, because they can't do this like just in time kind of component arrival. So basically my comments is just that they're basically a victim of trade war, because when the trade war happened, all the tariff barriers, all their capacity was in China. So they're just under this transition, and the transitioning is that they're transitioning now more production to Vietnam with new customers. So this stock looks attractive because of the huge cash on hand, but it will just take some time because they're just transitioning everything into Vietnam. Okay, I think that's it for me. I think we can move on to questions. Thanks. Turn on your question video if you're doing any answers. Thanks.
I guess I'll go first after seeing so much question. So yeah, just give me a moment. Okay, so I'll just go through these one by one by the order of popularity in the Q&A. First of all, you can see me right and the screen. So just say yes if you can, and then I'll move on, right? Okay, so yep, okay. All right, so first up, I think I have the CapitaLand Invest, and then followed by GKE. So for CapitaLand Invest, like I mentioned last webinar, the failure to actually surpass $3.54 actually indicate that that CapitaLand Invest, after the first impulse wave, since its debut in September 2021, is actually consolidating for a complex corrective wave for wave 2. So if you can see, this like really kind of like running flat. So yep, just say just 0A and B, and perhaps this may be C. Okay, and then it did came to my support at $3.30 and $3.35 once again, but however, I think the sustenance of it really sees we'll really see how it goes. So if it fails to break $3.45, then it could be a potential head and shoulder, and price may just go down deeply into $3.22 or $3.14, a mid-level kind of retracement going forward. Okay. So for next one, GKE, ever since its upside break in July, prices has been ranging down. So I foresee that this support zone 1 will actually be broken after so much attempt to test. The upside actually was just a retest of it, with a correction in terms of this bearish wave, bearish impulse wave. Reason being, price still unable to break 147 to 152. So hence, any upside will just see it as limited, and then price will actually just correct down. The main support zone we should be looking at is 113 to 117, moving forward in the longer term. Okay. Move on to Hong Kong stocks. For Hong Kong stocks, you can see that actually Alibaba actually has a strong gap down, means that the inverted head and shoulder that we'll be seeing is kind of like invalidated. But however, I think the another hopeful thing is a double bottom, but I think that there may be a false breakout to 13119 region before rebound. So you can see that from this, you measure the high to the low. There's 120 and 119 region of a false breakout, which is like from the Wyckoff type of theory, is a kind of spring test before going up to the upside again. So this is my theory on that. Okay. So the next one, Razor. I have not much comment for it, except that it has been going up on a higher range. However, I think the RSI momentum is way oversold. So I expect some form of correction, right? We may be looking at a corrective downside to support at 245. If not a deeper pullback to resistance and support zone at $2.21 to $2.32. Let's say if it did really goes higher, based on the 4 hour, this do look like a pennant. Okay, pardon my drawing. All right, so if this do really happen, then we need to see a confirmation break above the resistance at $2.94 to $3 over there. But even if it breaks, then I think $3.22 is likely a terminal, and price will revert back to a mean reversion back to $2.21 to $2.32, or the next support at $2.45 moving forward. For Singtel do offer a very offer a very good potential upside, but do take note that the Ichimoku, the first sign of a bearish crossover of the Tenkan and Kijun Sen has already happened. So despite there's a piercing line or an engulfing candle, we do not know, right? But this support at $2.53 must be broken immediately upon the formation of the candle, of the bullish candle. So if it breaks successfully, like I said, like I think 2 webinars ago, I think I foresee Singtel to actually reach $2.64 to $2.69 target price moving forward. Okay, you can see that there is a potential double top. So if price do at the end of the day sustain down, resistance and support 2441 and 244 likely to be a short-term rebound to the upside. Okay, major formation, major support at 214 and $2.23 is kind of like fulfilled. Another thing I would like to point you to attention is the ending diagonal kind of pattern. So if it is kind of like break, it has already broken down. So if we continue to break up to the upside, it continue to stay outside, you'll be ranging, and then chances are that price may be falling down. But if we do close up above $2.50, this $2.53, then likely we are seeing this as a false a bear trap, and then price will likely revert back higher to the resistance zone at 264 to 269. So the next one is AIMS APAC. AIMS APAC, nothing much for me, but can see that there is a descending triangle forming. So likely price is going to hit up one last push higher before coming down again. Okay, so look at the weekly chart. The 1:1 AB equals CD Fibonacci expansion trend has been on point. He has already reached $1.55 target of the expansion level. So price is likely to face another wave of correction down, testing $1.30 to $1.33 moving forward. So for next one, Jaffa, I think Jaffa is like really a curse to me. Issue a report, three report, all end up in the stop loss. So, but anyway, prices has continued to move down. Strong bearish downtrend. I think you look at the weekly chart. I think it has reached the terminal upside resistance zone. Price is likely to hit down lower going forward. So support zone 1 at 0.475 to 0.51 likely to be a next target of rebound. So we are likely to see some sort of like because of this potential bearish flag, smaller one. So we likely to see some terminal upside before going up to the downside again. Before rebound at 475 to 510. Also 420 and 395 are potential support as well. If should Jaffa enter into a very deep retracement down to the downside. Next, moving on to Comfort Delgro. Comfort Delgro, I remain bearish. Okay, like I said, I still expect price to rebound at 141 to 145 region. Reason being is because the descending triangle, although it has formed a true wave up the upside, but tweezer top has pushed price down. Terminal bearish breakaway gap, Ichimoku signal that price is on the bearish downside, with all prices trending below the Kumo, below the Tenkan-sen, Kijun-sen, and the lagging span. So price is likely based on the Ichimoku wave cycle, we are facing one more downside level. So for Hang Seng Tech Index has been doing relatively well. The triple bottom or this smaller head and shoulder is kind of like forming. But looking at a micro level, retracement level, prices do really need to stay elevated above 61.8. If it fall to 78.6, then means that the selling is stronger. So we might push all the way down to the deeper mid intersection of the major support zone at $1.06, $1. Okay, just round off before a rebound to the upside. Okay. So for Hongqiao is China Hongqiao, which crosses below 1:1 of AB equals CD. So we are looking at $1.6185.97 of this bearish flag before we observe a rebound to the upside again. This is what I feel that there is that is going on. Okay. So for straight trading, not much except that, you know, I think if I'm going to make it is ABC, so 1.236. So this level may be a strong level. If not, I'll be looking at 1.618 level for the next rebound over at $3.31. If this level is well supported, then there will be a chance of going up to the upside again. This is ABC. Okay. For Sheng Siong, not much. Sheng Siong, I think there will be one more upside, going down sub support at $1.44 before rising up to test $1.55 to $1.58 before reverting down to $1.32 to $1.36. Reason being because I think this descending triangle has been like relatively well confirmed. Price is likely to break up on the short term relative basis. But longer term support, I will still view it as $1.32 to $1.66. Reason, if I'm going to point you to the weekly chart, I think we are seeing one more. We're seeing like an end of an uptrend. Now is back reverting to a corrective zone. You can see that the support zone that I highlighted has been confluencing with the 61.8% Fibonacci retracement level of the immediate swing high to swing low. This is based on the last year where COVID really has where the COVID happened. The upside it has went up to, and then this was this year. And then, but the rally didn't sustain, and then price is going to go down. So we are finding a strong support over here at $1.32 to $1.36. Okay, so next one is Maple Tree Industrial Trust. Prices still remain at below the downtrend. So support is likely to be this gap zone between 2.57 to 2.55 region. All right, so look out for this support. Bearish flag has been confirmed, so we are likely to see one more downside again. All right, even if there's upside, I think it won't actually clear $2.70. $2.70 might be the selling level to push price below. Okay, so Yang Zijiang, like I said, Yang Zijiang 5 wave has been completed. Prices now is forming a larger correction. Head and shoulder breaking down of this support at 134 to 138. Prices are likely to make a rebound to the upside again. Prices major rebound will be 1.08 to 1.14. So this is what I've been saying for a very long time. AJBU Keppel DC rate, I still maintain my view. $2.22 to $2.28 is my buying level. Wilmar has today this bullish engulfing candle potential. I must say that because market haven't closed yet, so we can't confirm it. But the good news is it's showing some sort of like potential good news. So prices is likely to go up higher, but the crucial thing is $4.45 and 40 cents. $4.40 and 40 cents must be broken. If not, you'll form a sub head and shoulder, means that price might actually go down to the downside. And if that happens, then $3.88 to $3.80 will be the likely buyback level for that. So yeah, that's all. End of my Q&A. So yeah, if you have any question, just continue to type in. All right. So I'll pass my time to my colleagues. Thank you.
I'll take the next question. What is Keppel Corp's future like now that they are unlikely to diversify their business through the SPH acquisitions as previously hoped? How does this affect the valuation? So there are two questions. I'll take the first question first. Now that Keppel will not be able to acquire SPH, then I think the focus will be for them in the near term will be two things. The first key initial thing that they want to do is to diversify, to divest rather their O&M business. So they want to divest the O&M business to Sembcorp Marine. Recall that they are expected to receive about $500 million from that disposal of Sem Marine. So they expect the completion to be in the first quarter of 2022. And if they can complete the acquisition, then we see the removal of the overhang from the O&M business. Then they can focus on growing with the new cash infusion. They can focus on growing the other business areas. The second thing is that they will want to achieve is the monetization of $3 to $5 billion of assets. They've already guided that they will look to monetize $3 to $5 billion by 2023. So they will continue to do so. By 2023. In fact, we expect the timeline to be a bit earlier than 2023. We expect them to be able to complete the $5 billion, the higher end of the $5 billion target range by 2022, 1 year earlier. And then what they will do with this monetization is to invest in new growth areas. The second question is, how does this affect the valuation? Our valuation of Keppel did not take into account the acquisition of SPH. So our valuation of Keppel was based on their existing business, so there is no change or no effect on our valuation since we did not account for the SPH acquisition inside our model. Let me know if I answer your question, but if I didn't, you just follow up with another. Any Keppel Corp share opinion now that they are unlikely to buy SPH? So I think so. This question is a bit similar to the one that was asked earlier on, but I think we could see some. It could be a slight positive on Keppel's share now because the uncertainty is removed. So the uncertainty with regards to the acquisition of SPH is removed. So we could see a bit of re-rating, though it's not good that they didn't manage to complete the acquisition. Let me just scroll down to see if there's any more questions before I hand over to my colleagues. I think, yeah, that's all for me. I'll hand over to the rest of my colleagues.
Okay, I think I'll take the next top rated question, which is the SGX. So the question is, SGX keeps dropping. Any views on the FA and TA, please? So for the FA side, one of the main reasons why it could be dropping would be that because of the new Hong Kong exchange, the HKEX, there are MSCI China A50 Connect Index futures. However, this was only released, sorry, not released. This was only newly done late last month, late in October. So we don't have enough data yet to compare and see whether it has affected SGX. And this is a direct competitor to SGX's FTSE China A50 futures. So if more time, we can do more analysis on the data. But for now, I think people are sort of thinking that this will affect them quite a lot. For the TA wise, maybe I can pass over to Wei Ren.
Hi, Glenn. I think I'll answer later. So pass the time back to the rest for, yeah.
Okay, thanks. I'll just take on one of these questions. Would you still promote Marathon Digital if they are undergoing investigation by SEC? So Marathon Digital is one of the US LISCO webinars that we do. So we in a way, it doesn't mean that when we put them on the webinar means we promote, number one. Number two, our main purpose is just to give them to give access to investors. I think last time even Oceanus was on our restricted list, but we also still did a webinar. The main purpose is that we just want investors, attendees like all of you to know, get the opportunity to see them and listen to the story and make the judgment yourself, because although we don't cover and we don't give recommendation. So that's why it's glad. We're just hoping that they will still do this with us, even though there's this SEC investigation, and just explain their story, their version of this investigation, and more important for us to kind of educate all of us what is Bitcoin mining about. Yeah, because it's very rare we get such a company. And the other question was where to get all our, you want to register, you can either get access to the webinars through our Poems web page, the seminar page, or alternatively get into our Telegram chat group, which I think we can pull out the slide later for anyone. In terms of nanofilm, nothing particular, but I guess this company, please comment on nanofilm, seems to be attempting a breakout of consolidation. I think near term, this company probably linked a lot towards their largest customer, which they call customer Z, and is the largest mobile phone operator in the world, which I think we kind of know who it is. So maybe how the customer's performing, that could be one of the drivers. Again, we don't have coverage of, sorry, we can't really give much comment on that. Next one, any comments on IPO more East? Not really, can't give you on that because I'm not very familiar. They didn't do a briefing. I think Vivian, any views on Daiwa REIT IPO? Vivian might have just attended it. I'm not sure if she can give some updates for you on that later on, Daiwa. Let me just run through two questions first. Q&M expansion of clinics, appreciate comment if there's sufficient demand that justify the investment of doubling the clinics. Yeah, so thanks for the question. So actually the management were themselves always unclear whether should they actually expand. They were always worried about cannibalization, but as they expanded new clinics, they realized there is demand, and they also realized that although they're the largest, they only have 10% of the market, and new clinics can generate, again, it depends on the range of, and it's not very clear because they don't really disclose that much. It could generate almost 200,000-300,000 to almost 1 million in revenue, and also new clinics, they only cost, I think, 200,000 to open. So even if you have 10 clinics, it's 2 million. 200,000 is mainly for the equipment and refurbishment. So the payback is actually quite good, and because of the branding, it also helps reinforce the branding for them. And right now they almost have like 300 dentists in their portfolio. Yeah. So I think there is a payback. Otherwise, they won't. Actually, they're doubling down on expansion. I think they realize that there is demand. I mean, like you mentioned, they were also skeptical, right? Because you open, then you cannibalize, and in the end, net you. But they realize as they open more clinics, they do get the patient flow. Hi Paul, would you be personally recommending buying the dip for Valuetronics since the weakness appeared to be external and transitory and not due to internal problems? Yeah, it looks interesting. I think we can't, because we are licensed, so we can't really say buy or sell, but it looks interesting because this seems to be external. This company has been listed, I think, more than 10 years, if I'm not mistaken, and they've gone through, this is probably the second or third time they've gone through this kind of down cycle. The last one I remember, maybe 8 years ago, they tried to do their own products, but it was not successful. Then they did a lot of write-offs, and they still managed to recover. And throughout I don't know, this decade, they've always held a very strong net cash balance sheet. I think right now it's probably at the lowest. They used to probably have almost more than 200 million, I think the peak. So with that type of cash, I think they managed to ride through and they've always shown to be very good in executing their electronics. So you strip up the cash right now, their PE right now, excluding the cash, about 4 times PE. And this is considered like earnings low, hopefully. Yeah. So I guess, but the thing, this stock may not rebound until earnings-wise, until maybe the end of next year. Then only you see. So maybe not everyone will be so patient, I guess. Let me see. Any thoughts on Natalie's on leave, so she can't, no views, so she can't really give an update on CDL for now. Yeah, sorry for that. I'm not sure if there's chart. Yeah. Okay. Hi Paul, this is my last one. Hi Paul, since you mentioned Hyphens Pharma is for long haul, does that mean it's a dividend stock? If not, what's the reason to hold since the upside is also? Yeah. Our target price is only mid-teens. This one is more if you really, the near-term catalyst will be the new acquisition can maybe spike earnings by, like we mentioned, 20-30%. But the long-term story is just, you just have to, for those who believe that, because it's very hard to get any branded consumer products in Singapore, listed, at least for Singapore. So I guess if that's the only reason, if you believe in the branding. Otherwise, the yield is also quite small. I think it's only 2% yield. Yeah. So that's why our upside is only, I think, mid-teens. Is 6 times PE for Singapore, Australia too low? Sorry, I'm not sure what is 6 times. Yeah, sorry, I'm not sure which country, which company you're talking about. Yeah, sorry. Any SGS company could benefit from virtual reality industry focus led by Metaverse? Oh, I don't think so. I think, yeah, we are not really, now, you know, our Singapore, not very, we don't have really huge presence on tech. And any views on coming IPO, Vivian, are you able to share anything?
Yeah, hello. Okay, I will be sharing a bit on the IPO of Daiwa House Logistics Trust, DHLT. So the indicative market cap is about 540 million Sing dollars. And if you were to compare that to the Logistics Trust or ESR REIT, it's actually quite small. And the public offering is about 4.3% or 10.2% of the base offering. So the public offering will be closing at noon on Wednesday and the trading to commence on Friday this week. So touching a bit more in detail on the sponsor first. So they have a very strong sponsor, which is called Daiwa House. They already have a REIT listed in Japan, and that is actually a mega REIT with a diversified portfolio of about 200 plus properties, but they are primarily focused in the Japanese domestic market. So that is also one of the reasons why they want to list in Singapore, because they have plans to diversify in Asia and also actually a few properties in the Southeast Asian region, so in ASEAN. Yep. And secondly, on the fundamentals, so this is a pure logistics trust. So for the logistics properties in Japan, they are actually facing high demand with, they call it 3PL players. So the third-party logistics players have grown rapidly over the past few years as Japanese companies are outsourcing the distribution functions. And also secondly, similar to, I think, anywhere around the world, e-commerce has also grown rapidly, especially due to the pandemic. And thirdly, on the valuations of the portfolio, the appraised valuation is about 950 million Sing dollars, but the purchase consideration is at a discount of about 11.8% of 840 million. So I think you can say that this shows the sponsor's strong commitment to DHLT. Yep, and on the more in the portfolio, so they have a high quality logistics IPO portfolio. Now currently is 14 modern logistics properties, and they have around 96.3% occupancy. This is actually quite high, but if you were to compare maybe to some time ago, it's actually down from about 99% previously. So it's basically full occupancy. That was due to a few tenants moving out. Yep, and On the makeup of the portfolio, so mentioned on the high quality third-party logistics and e-commerce players. So majority is occupied by this, they call it blue chip tenants also. So it's around 79% of the NLA is occupied by these high quality tenants. And in terms of geography, they are also well diversified with assets in Greater Tokyo and also core regional areas all around Japan. Yep. And another point on the well diversified would be they have both single and multi-tenanted assets, and that gives them also potential for positive rent reversions. And of course, there are a lot of growth opportunities. So the current pipeline of assets under the ROFR assets, which means they have the first right of first refusal assets, total about 28 assets with 1.1 million square meters by NLA, and also further potential assets for acquisition. This is assets under the sponsor, which is Daiwa House. Yep.
And you have the dividend yield?
The
dividend yield for Daiwa House.
Yeah, we'll be covering that later. So maybe just the last thing on the assets is that the assets are very new, with the average portfolio age of about 3.7 years only, and the aggregate WALE is about 7.2 years. So lastly, on the valuation, it's according to the price is about 1.05 times price to book, and 6.5% projected distribution yield for FY22. And they compare this to a 10-year Japan government bond yield of 0.05%, which is very low. And if you were to compare this to maybe the local, Singapore logistics trusts, it's actually the distribution yield is very high. So if we were to compare to Mapletree Logistics Trust or ESR REIT, distribution yields for both are at about 4%, 4.3%, and also at around 1.07 times price to book. But if you were to compare maybe to the European players like the Cromwell European REIT, then that would be about 6% at around 1 times price to book also. So if you were to compare to local Singapore players, then you can see that they are for DHLT, they are on the cheaper side. Yep, so that's all I have for Daiwa House. Hope that helps.
Thanks, Vivian.
I have a follow-up question on Keppel. I think I addressed this. If Keppel were to divest their marine arm, will it help in its share price? So if it's just the marine arm, we think that there could be a potential re-rating of Keppel, because Keppel has always set a long-term ROE target of 15%. So in terms of all its business units, all of their different business units are already, in terms of their ROE, is already above 15%. But the marine arm is just at break even and almost no ROE. So if they are able to divest this, then we think it can free up a lot of cash flow, the working capital requirement, and it will be positive for the shares. Yeah, that's all from me.
Okay, I'll wait for Glenn to because there's probably a question on OCBC. Just to follow up, yes, someone asked about the 6 times. Yeah, sorry, I missed that part. It's referring to the 6 times EV/EBITDA for Singtel. Why is that so low? Because we are, number one, it's a relative valuation, so we're comparing to the region. Number two, it is 6 times because this is based on EBITDA. And EBITDA, right, is excluding depreciation, interest, tax. Don't ask me why these are not important costs, but it's just a way to kind of measure excluding the way they some might have different depreciation policy, some tax policy. So that's why it appears low because it's based on EBITDA. Yeah, I hope that kind of answered you. Yeah, sorry, I missed that. I didn't realize that was for Singtel. How to buy Daiwa IPO? I guess, sorry, I'm probably going to apply for an ATM, I presume. Yeah, or maybe ask your trading rep for help. Yeah, sorry, I'm not sure if that really helps you. Okay, Glenn, do you want to take, there's a question on OCBC.
Yep, I saw it. Okay, I'll take that one. So the views, I'll just quickly dive into the positives and the negatives, right? So the positives would be that the fee income grew by 14% year on year. So this was particularly from their wealth management income, which actually makes up about 35% of their income in third quarter. But their assets under management did fall to 123 billion, which is matching the first quarter. And this is mainly due to the decline in market valuations, which offset net new money inflows. So the second positive would be that they had a GP write-backs of about 22 million during the quarter as the credit environment improved, and special provisions of about 185 million were made. However, their total NPAs did rise by 4% quarter on quarter, and this was mostly attributed to the downgrades of the secured customer loans in Malaysia. So nonetheless, they have set aside the SPs of 185 million for the corporate and consumer accounts in Malaysia and Indonesia. And one good thing is that the group's NPLs were stable at 1.5%. So for the negatives, the NIMs fell 6 basis points Q on Q to 1.52%. And this was also mainly due to the classification of loans to NPL, as mentioned earlier. And there were also more competitive corporate loans, which resulted in lower asset yields. So now the management expects the NIM to maintain at this 1.5 to 1.52% until the first half of 2022. But regardless, besides the NIM falling, the NII net interest income actually grew 3% year on year, and it's flat quarter on quarter. So this is boosted by the loans growth of 4% quarter on quarter. And the second negative would be that the loans under moratorium remain flat and at 2%, which is unchanged. And however, the portfolio and the net value increased to 6.3 billion in third quarter compared to the 4.5 billion the last quarter. So this was mainly due to the increase in Malaysia's relief loans to 4 billion in the third quarter compared to 1.5 billion. And this represents 19% of Malaysia's total loans. So however, the management has mentioned that the majority of loans under moratorium are still performing loans, with all the loans under moratorium in Singapore performing, and about only 20% of Malaysia's loans under moratorium are non-performing. The management do expect that this non-performing loans under moratorium to drop with an improving economic situation. Also, one more positive point would be that 89% of all these loans under moratorium are secured. So for our outlook, for the loan growth, it grew 6% year on year in the third quarter. And however, this is trailing the bank's guidance of a high single-digit increase for full year 2021. But the management still believes that this target is achievable, as it sees lending opportunities in the wholesale segment as well as the sustainable financing. So their green and sustainable financing was up 12% quarter on quarter to about 19.5 billion, and it forms 7% of its total loan book. So for their NPL, the outlook, it rose, as I mentioned earlier, and this was mainly from the downgrades of secured customer loans in Malaysia. However, this was offset by recoveries and upgrades of about 359 million, mainly from several corporate accounts in the oil and gas, support vessels and services sector. However, we do expect the loans under relief to nudge higher as the COVID situation recovers gradually in Malaysia and Indonesia. And in anticipation of this, the management has set aside the 185 million of SPs. So one last point I'd like to bring up would be the China exposure. So their total exposure is flat at 11% of the group loans, and the onshore exposure is 6 billion with offshore exposure at 26 billion. However, these customers are mainly the SOEs, the state-owned enterprises, the large local corporates, as well as the OCBC's network customers. So less than 1/3 of the group's mainland China exposure, which is about 2 billion, are corporate real estate loans, and they're mostly to the bank's network customer. The NPLs for this non-bank mainland China loans also have dipped to 0.3% from 0.5%. So we maintain our buy recommendation with the unchanged target price of $14.22. I think that's all for the OCBC. I think Wei Ren likes to answer some questions as well, so I'll pass it on to him.
Okay, thank you, Glenn. So just do a final what do you call it? Yeah, sharing. Okay, so yeah, so first of all, AEM has really broken up of the ascending triangle that was mentioned eons ago. It has really passed through the all-time high. All right, successfully maintained above $5, and then today the buying actually invalidate the bearish candle that was seen last week. But however, do take note that we are way above the oversold region, overbought, sorry, region of the RSI. So we need to be very extremely careful once it hit below beyond $5.20. Right, that maybe we may be facing a terminal kind of like a larger correction based on the wave theory. For SGX, I think Glenn has already mentioned the what's the outlook and the fundamental part. So from the charting perspective, SGX still remain on the downtrend. The descending triangle has been confirmed. Bearish crossover is on. Ichimoku is showing a very strong bearish downtrend. Like I said, I think for a few webinars already, $9.11 to $9.34 remain the better support zone moving forward. Inotech breaks off the falling wedge and then make a new high, higher low, higher high. But this harami actually will actually push prices down some more. So we are expecting a rebound to the upside based on 77 cents to 80 cents moving forward, going on. Okay. So for nanofilm, someone asked, is it breaking out of the consolidation? From the charts perspective, it's still within the consolidation. The hopeful thing right now is we are showing a slight of bullish signal. But do not be fooled that that we will go back to the $6.50 in any time. So likely price will face one more upside. So yep, you can see that price is making a terminal move to the upside, likely $4.50 or $4.77. But if you would like to ask for my opinion, I think $3.17 to $3.31 will be a better rebound zone moving forward. Okay. For APAC Realty, I think price is likely to be consolidating within here. Likely, I think we are moving past that. You can see that head and shoulder type of formation is formed. So there is the threat that if 0.73 cents is broken, we are likely to see a larger correction going forward. Okay. Also, he has already reached the terminal selling point at 7945 to 9885 based on the weekly chart that we've seen. Okay. And then also, if you look at the wave theory, I think if you wait, hang on. So we are at the, if you say we are at the, this is the ending diagonal. So we are A, B, and then if this really is a head and shoulder, then we are likely to see wave C at 61 cents in the longer term. Same thing as PropNext all-time high, but lack of volatility momentum. We are seeing maybe a rebound at $1.60 for rebound to the upside. Okay. IFAS, I think IFAS is still IFAS is still, like I said, still bearish. We are facing a third wave of correction, potential bearish flag. One more upside at 927, then we'll just go down to support zone at 756 to 786 region moving forward. So yep, this is what I have for IFAS. Franken remain corrective. First of all, it fails to break the key resistance at $2.41. Largest support remain at $1.90 to $1.99. Also, maybe you can look at $2.07 as well. CapitaLand Intercom CICT, breakout of the ascending triangle, facing some sort of reversal at $2.22 to $2.26. City Development, I think descending triangle, so we are seeing a after it complete the Ichimoku 3-wave pattern. Wave theory suggests that Ichimoku suggests that we are right now on we may be facing one more downside correction after a bearish crossover and Chico span breaking out, breaking in below the candles. Seiko span A remain flat, so there's like some sort of like a divergence going on over here. ADX, the average directional trend index, is remain at a low. So anytime we are seeing some sort of like non-trending moment for city development. Keppel Corp, someone asked just now, what's the outlook? I assume it's technicals. First of all, the major resistance at $5.30 is actually major resistance and support already. Has been rebounding well. You can see that there is a minor kind of like a falling wedge kind of pattern over here. So it has already broken out. So we expect one more break to the upside. If $5.48 is going to break, and then we are expecting $6 region to be actually the midterm target moving forward. OCBC Bank, likewise, I think today there is a bullish candle that is being forming, but if it fails, $11.59 to $11.66 will be the next likely rebound. LHN, no comments. It's likely remain illiquid. It's now some sort of like consolidating kind of phase right now. SIA, I think SIA will just face a one more break to the downside. Will likely rebound maximum level at $5.09. Then lastly, Riverstone is still on a downtrend. All right, that's all from mine. So I'll pass my time back to Paul or rest of our colleague to do the closing or answer any last question. Thank you.
Yeah, okay. I think in view of time, I think thanks everyone. I think we probably have to end it because Bayron has another 1 p.m. session. If you have questions, just send it to us. I know there's some US questions here, but I think the next session is US questions, so probably can get those answers there. Okay, with that, I'd like to thank everyone and have a great week ahead. And thanks for your questions and participation. Thank you, everyone. Take care. Bye-bye.